Hello, traders. This is Rachel Deshelle, Senior Manager of Trading Services and your host for Long Options. This is a webcast where we focus on option buying strategies with the assumption that you're already familiar with the basic concepts of options. Now, if you're not, you are still welcome to stick around for the rest of this webcast, but you may also want to watch our other webcast series for getting started with options first. Now, today I'm joined in the chat by Brent Moores. Please follow us both on X. He is Brent Moores CS. I am Rachel CS, and he has been great in the chat answering questions, comments, all the things. So please chat in your questions and comments to us there. And please like this video and subscribe to our channel, Trader Talk Schwab Coaching on YouTube. So let's go through a couple different disclosures today. We are going to start there and then we can get into our agenda. So options carry a high level of risk and are not suitable for all investors. The information that we're going to cover here is for general informational purposes only and should not be considered recommendations or advice. And we're going to place some trades on the Paper Money platform. There is some differences between paper and live, so be aware of that. Now, getting into our agenda, we're going to cover an announcement first, then we're going to do our market overview, review our old trades, and then get into discussing the concepts of long options, the concepts of price, time, and volatility that are all going to affect the value of our options, and then we're going to place a couple example trades today as well. Now, as far as our announcement, we do have some upcoming workshops and market drive events here. So the next one that's coming up is in Miami. It is Advanced Options on the 19th and 20th. I will be there. So if you are going to be in Miami, definitely say hi, give a holler in the chat. And then we have a couple into the new year. We have Dallas, January 9th and 10th, and Bellevue, Washington on January 30th and 31st. So let's just kind of get started here and jump right into our market overview here. So I'm going to look first at the Dow Jones Industrial Average. And I know last week on this webcast, really every week on this webcast, we kind of start with this process. And I know one of the things we mentioned was the 100-day moving average that we had found support at. So I'm actually going to add that here so you can see that as well. We found support in all the major averages right at the 100-day. We are now today we're surpassing that 50-day moving average. We're trying to battle with that 20-day moving average in the Dow. So seeing quite a bounce from that bullish Harami candle on Friday there. Same with the NASDAQ composite. We're just a little bit further from that 20-day simple moving average, but we are battling with that 50-day moving average here. We saw that bounce at the 100-day right at that 22,200 horizontal support line. So looking at seeing if bulls will continue that pressure throughout this week. And then the S&P 500, again, similar picture to what we're kind of seeing in the other averages, found that neckline support right around 65.50. So more similar to what the NASDAQ was kind of showing us there. And then we see the bounce. We're reclaiming the 50 and the 20-day as we speak. So a lot of things to definitely watch in this market. So let's get into reviewing some of the trades that we were in the last couple weeks. I'll kind of start with our LEAP trade that we did a couple weeks ago here. So we placed a LEAP trade in TJX because we saw that long structural uptrend that still remained intact. So we are up on that position a little bit there. And as the price of this stock moves up, or I guess the price of the option moves up, we're going to adjust our stop along the way there. And then as far as some of the trades that we actually closed out last week, so HIMS was one of them. I'm going to pull up the chart of HIMS so you guys can see that kind of pattern that we were looking at there. We saw that triple top pattern. We bought a put on the way down with that percentage filter, and we rode it all the way down almost to this gap. but I was moving up the stop along the way. So let me pull this back up. I was moving up the stop along the way. So we got in at 12.75. We got stopped out at 14. So we still took a bit of a gain there. I think that's about a $250 gain there. So while it's not exactly what we kind of imagined, sometimes it is better to just kind of take those profits where you can. And then Amazon was the other one that we looked at. Let me type this in as well. Okay, Amazon was the other one. Now just to kind of pull up a chart on Amazon to show you and kind of remind you what we did with our trade here. We saw that Amazon went back into this box type pattern here and was moving lower. So that's where we were buying our put, kind of thinking that we were going to reach that downside support there. Just like HIMS, we didn't reach it completely, and we were moving up our stop along the way, so we got stopped out at 20. So still took about a $540 gain there, which we're not going to we're not going to complain over profit. So that's kind of our trades there. Now today, I know it's been a bit of a choppy market. Obviously, we've kind of seen kind of those whipsaws that we saw in the major moving averages. And I am someone that looks through hundreds, if not thousands of charts. And there are a lot of charts out there that a technician would say could be a little messy, but there are some that are poised for breakouts and patterns and things we could be watching as traders to capitalize on. So I want to take a look at a couple different trade possibilities here that I found when we were looking through some of the charts. And let me check the chat because I see a couple questions there. Base hits win the game. That is true, Paul. That is true. And then Linda, you asked, can you elaborate on placing a stop and how you determine the percentage or price to place a stop? So what we actually did in our prior sessions was we're working with our trade size and trade risk. So that's kind of how we're determining where to place a stop order, because our trade size, we're not risking more than 5% of our account in the trade. So that's a little over $6,000 that we would put into one particular trade. And then we're not risking more than 1% of the account, which is a little over $1,000. So when we calculate out our trade, kind of like where our entry is versus where our stop should be, we're making sure that we don't breach that point as far as taking on too much risk in one particular trade. So that's kind of how I go about it. And then as we see the price of the stock move in the direction, we just kind of incrementally move the stop up as we go. We will go through placing a stop trade today, so I'll save the second half of that question for a little bit later here after we look at a couple chart setups. So we will get to that one, Linda. Now, let's look at a couple different bullish setups today. We're going to place two trades. They are going to be we are going to buy calls on these chart setups today. So we're going to take advantage of a bullish move with more capital efficiency by buying that call option. So I'm going to start with a healthcare name, CNC. And I'm going to also take off some of these moving averages because sometimes they can just kind of hide the price of the pattern that we're kind of seeing here in the setup. So while I have this chart on the screen, I want you to throw in the chat what type of pattern that you see here, because I see a pretty well-defined possible pattern set up here that could be setting up for a possible bullish scenario there. So if you guys see a pattern, please throw that in the chat. And I'll kind of see as they trickle in if you're seeing the same thing that I am seeing as well. Paul, I see you. Cup and handle. Yes, that is what I am seeing today. So thanks for putting that in there. Great minds think alike here. So what we're seeing at the bottom of this market is really forming this cup and handle pattern that really started at the beginning of July. So we have the cup really taking place here. We have the handle here, and now we have this breakout that we are looking for here as well. And there's a lot of space to fill here. So this entire gap is obviously going to act as resistance, but we could also look at kind of this ledge that we saw being touched a few times as a level of resistance there. So for those that are new to price patterns or new to a cup and handle pattern, now I teach a webcast tomorrow on trading price patterns every Wednesday at 1 p.m. Eastern time. We get into depth a little bit more about these patterns, but since I do see a couple patterns, really pattern breakouts today, we're going to place trades based off of that. So we'll get a little into the weeds here, just showing you how to trade a cup and handle pattern here on the upside. So this is essentially a bullish reversal pattern here. Now the cup really takes the shape. It's called like a cup or a bowl, sometimes a saucer pattern. It hits that first level of resistance that we saw before. And instead of breaking through, price really retraces usually 1/3 of the way down the cup. If it retraces any more than that, it's not typically a cup and handle pattern. So it typically retraces about 1/3 or less before forming a fractal, a similar shape, but a smaller shape up to the upside again with a breakthrough of resistance. So just like most patterns, when you're looking for possible upside objectives, now these are never guarantees, but just kind of what traders would use as a measured move to the upside, we are going to take the entire largest depth of the pattern, which is the depth of that entire cup. So that's looking at about a $14 move here. And if I duplicate that drawing, kind of move it up to, whoops, I think I clicked too many times. I just duplicated that drawing and I'll place it as far as a possible upside target should we see that move continue. It's funny how technical analysis works sometimes, and this is why it is sometimes fun for traders, or it makes traders giggle a little bit. At least it does with me, just how some of these targets kind of play out with former support or resistance levels. And we are seeing that possible move of the possible cup and handle pattern could place it at those former support, new resistance there if we were to close that entire gap. So I thought this may be a good example trade since we are seeing bullish moves in rotation in the healthcare sector. We are obviously seeing this pattern take place here as well. So let's look at placing a possible call option on this. And a couple of things we're going to watch is one, the time that it took to form this pattern. We said that it took since the beginning of July there with this cup and handle pattern. So it took roughly 5, almost 6 months here, or I guess about 5 months. So we're going to give ourselves enough time to where we're going to give ourselves at least 5 months for our expiration date so that we give that measured move enough time to possibly reach that target if it is going to go in that direction and that those pattern objectives play out into the future. We're going to look at least 5 months out and probably give ourselves another 30 days kind of on the tail end of that, so we just don't see as much time decay, which we'll kind of look at here in a moment as we shift to the option chain. So that's one of the things I want to kind of keep in mind as we're crafting this strategy is the time that pattern took, how long we could possibly wait for that possible move to play out. So let's move over to the trade tab here and let's look at the options. So down here today, obviously, ton of volume occurring in the options, a ton of volume occurring in the stock. That kind of gives me a sense that, okay, we'll have tight enough spreads there. We'll look at the open interest. We'll look at the volume on each of these as well. But since we are nearing the end of November, getting into the beginning of December, and we wanted to give ourselves probably around 6 months, I'm going to look at the 18th of June, 2026 to give ourselves enough time here to have that possible move play out. Now, we can kind of see here, if we look at theta, we talked about that time decay, and theta is really with that passage of time with each day of time passing, that's going to give us the expected move on the option. And as an option buyer, we lose that time, we lose that value each day. It would be the opposite if we were selling options. We would, our theta would benefit us, or time decay would benefit us. But in this case, we are looking far enough out that we are only going to see a very incremental amount of time decay, 1 or 2 pennies a day, theoretically, that we would possibly see there in the option. Now, I see a question in the chat there. I know Paul mentioned 6 to months minimum. You're exactly right. So, yep, that's why we're looking at the 18th of June. And then I see Sai asked if we could do a put credit in CNC instead of a call option. You most definitely can. If you are following along, placing an example paper trade with that as well. That is essentially a covered risk type of trade. But since this is a long options class, we are going to go through buying a call option, especially since we see that bullish pattern and a large possible move to the upside that could possibly take place. So we're just going to work with that today. But let's take a look at what strike that we could be looking at. Now, we noted the liquidity in the options before, and we can see here CNC's options are pretty liquid. We have a few thousand in open interest on the call side, which is the side that we're kind of paying attention to today since we're looking for that bullish move. And then we even have some volume, light volume in the contracts, but enough to give us tight enough of a spread to buy those options there comfortably. So I'm going to look for an option with a little bit of intrinsic value, meaning that the price of the stock is trading above that option, to give ourselves a little bit more of a nudge in that directional move. And we can even take a look at that with the delta as well. So that delta tells us direction. So if the price of the stock theoretically goes up $1, theoretically our option should follow suit by going up 65 cents. Now, over time, that delta is going to get larger and larger, and you can kind of see that if you look at the closer expiration dates. The other thing that's going to make that delta even larger as a kind of as a result of the gamma is going to be if the stock price continues to move in our direction or continues to move to the upside. Because you can see these further in the money options will have a higher delta. And the gamma is what's really giving it that move, because gamma is that gas pedal. So that is really the rate of change in our delta, and it's going to give that an additional push to the upside there with the deltas there if it should move in our direction. So let's just go with the 37.50 strike call. That's about $2 in the money there. And to one of the questions earlier, I know Linda asked in the chat about placing a stop order. So we are going to go through a paper money trade or an example trade that's going to use a stop order. We are actually going to leave our profit targets off on this one to just kind of let the trend ride, and we will place a stop at an initial level and move it up as we go if the price of the stock continues to move in our direction, since we are holding this option for kind of like a long time period. So I'm just going to right click on the asking price here, go to buy custom, and go to with stop here. Okay, so that is a quick way that you could just build that stop order. You can see in the lower left-hand corner, it's an advanced order or first triggers all. You may see it as a first triggers sequence as well. And this will give us basically our first entry order there of entering in. I'm going to start at the midpoint here today. And since we do see that breakout, and I'll kind of go back to this one here, we are seeing a move above those prior highs there. So that's going to give me enough of an indication today to just place this paper money trade. Now, if you want to wait a little bit for further confirmation, maybe you want 2 to 3 closes outside of that range. Maybe you want maybe a 1 or 2% move above the resistance level that we're kind of seeing there, you can definitely wait for that move. I know a lot of traders would wait for that type of confirmation, but just for today's example, we are going to enter into this trade here. Now, we talked a little bit about in the beginning about the trade size and the trade risk. So the trade size for our account, we can trade, I think roughly 6,200, 6,300. So we can bump these number of contracts up. And what we're going to pay attention to is on the downside, how much risk we can possibly take. So on the downside, if we just had, let's say, 3 contracts here where we're spending about $2,100, and if we just had the stop $1 below at 635, well, take the difference between our entry price, our 735, minus our 635 example here, that only gives us that $300 of risk that we're kind of taking on to the downside. Now, it's important to know that the most we can lose on this option, obviously, is that premium that we're going to pay. But we are looking to get out of this option before we would hit max loss if it does not go in our direction, and we're going to manage our risk along the way. The thing to note about this, so using a stop order, especially just a traditional stop order, it is a stop market. So that price that we are going to enter in here is going to be just an activation price for a market order. So there is no guarantee at what price you will get filled at, get executed on in this trade. But the benefit of that stop market order, is that we get out immediately as soon as the asking price of the option hits a certain price. So as far as our downside risk, we are going to put a 50% stop on this option. So I'm just going to take 735 as our entry, divide that by 2, and that gives me 367. So that is where you can calculate a 50% loss. So hopefully that helps there. Now, like I said before, we will move up that stop as we go if the price of the option continues to the upside. But that is what we will be looking at here. And if we just kind of take the difference between 735, 367, multiply that by 3, that's still giving us, or I guess 300 in that case, is still giving us it's still allowing us to stay within the parameters of our risk on this trade. So I'm going to make this good till canceled. This order will be good for 6 months. You can always go in and change it. But let's go to, I'll put this, there we go. So we're just going to put this at the midpoint. We're going to hit confirm and send. And I'm going to make sure we send this in the long options account. So we know, we talked about the max loss on the option, which is how much we are paying for that premium. We are looking to get stopped out if we take a 50% loss. We know that with a long call, the stock could theoretically go up to infinity there. So we mentioned, since we see from a patterns objective, a possible pattern objective, we could see some upside there. So looking to keep our profits open. So just that first triggers stop order there, and I'm going to send it because everything looks okay to me. It is sent, and we got a fill. Okay, perfect. So let's take a look, and I see in the chat you guys are calling out Microsoft, Doji, and Hammers at the 200-day. Do we want to take a pause and look at that for a second before we move into the next trade? Okay, so we saw a little bit of, now that's not necessarily a harami, I would say, since those two colors are different, but we are seeing that hammer candlestick. We'll have to see where price really kind of ends the day, because if it ends near the top of kind of right by the high, obviously that will be a candle or a hammer candle. But if it really closes the day at where it opens, that is where it will be that doji candle. And that hammer candle, like some of you may know, is typically a bullish reversal type candle. You would actually have to wait till the next day of trading to actually confirm that candle, because you would have to look for that follow through. So that's when it becomes a confirmed hammer candle in that case. And then a doji candle is more of a pause, could be a possible reversal, and dojis are definitely more significant when they occur at a level of support or resistance there too, as with any candle pattern in that case. So there was Microsoft. Now we're going to go to our next example and look at another healthcare stock here, GEHC here. And I see a pattern developing over a long period of time here. So if you see a pattern, please throw it in the chat. I'm wondering if you guys are seeing the same thing as me there, and I'll kind of start drawing this as I see you guys kind of putting your answers in the chat. But over this time frame, really since May 12th, we are seeing a big long range really taking place. And look how many times it's touched resistance. 1, 2, 3, 4, 5, 6 before breaking through. And then to the downside, we have 1, 2, 3, 4, 5, 6, 7 times that it's touched that level of support. And I drew these with the rectangle shaped tool there, because a lot of times these support and resistance levels are not one specific level down to the penny. A lot of times they are a bit of a zone there, because traders know when they are adding buying pressure or selling pressure, they know that there is going to be, or assume that there is going to be stops kind of placed below these levels. So that's why sometimes you can see price retrace a teeny bit more than the previous one and so forth. And then you'll see that with the new highs, kind of as well as that as well. So like that's kind of how traders can kind of assume where those stops will typically be placed in the market, but kind of focus on obviously that confirmation with the breakout, because that is what we are seeing today. We are seeing a swift move above that resistance there. And so we're going to take a long call trade here in this example. And if we're just going to use a little bit of a measured move of a rectangular pattern here, I'm going to start at the top of this zone, go down to kind of the bottom of this zone here, and that will give us a possible $10 move. So if I add this to the breakout point, put it towards the upside, this could give us a possible target right around $90 or so, $90 or so. Now Paul says, wait for a retest to enter. So that is something you could do, but there's no guarantee that price will retest that level. It does happen. We do see it quite a bit. Price may break out with a strong candle, a lot of volume, and may retest and try that support range again, but it doesn't always do that. So if you are waiting for that pullback, it may be a pullback that never comes, but you could always place an additional order. Like let's say you add to a position or enter a position here, and price pulls back and holds support, holds above a certain level, you could consider adding to that position with that support bounce there if it moves then back up to the upside there. And then, yeah, Paul, you're right. Still plenty of range if no retest there. So like if we see this as a false breakout and it re-enters into the pattern, that's going to be our indication to get out of this trade. So that's what we're kind of going to keep in mind, is obviously looking for a confirmation. So we're going to see what type of measured move beyond that resistance that we see here is taking place, and then enter a trade based off of that. And then we are going to make our exit if the pattern fails and moves back into underneath our support range. So let's just put this as an example. Let's put this scratch pad. We're going to say we are looking for a 2% move above resistance. And our exit will be, or our stop will be, if the price of the stock re-enters the pattern. So goes below 77.77. Okay, so we're going to use a little bit of a conditional order. I know we've done that in this class. We could also put a profit target to the upside right around 90, but for today's class, we are just going to leave the profits kind of open, let it run in that case. So let's just kind of take a look at the chat. I see you guys being active in there. No guarantee of anything, just buy and hold, sell at a price comfortable with, or hold forever. Could collect that huge 3.5 cent dividend. So Josh, you actually bring up a really good point. So keep in mind, even though we're holding this option for the long term, almost kind of, and I say long term because this pattern would take, this has taken about 6 months to break out. So when we craft this strategy, we're going to look at something obviously greater than 6 to 7 months. So with that in mind, you're kind of simulating or kind of letting that capital efficiency of the option almost take the place of stock ownership over the intermediate term, or some would call, depending on your time horizon, a longer term. But the major differences with that is with that long call option, you are not entitled to shareholder rights like you would be with the stock. You are also not entitled to the dividend as well. So keep that in mind. I know it's a teeny tiny dividend, but since you mentioned that, Josh, I think it was good to kind of mention that, a couple of the differences there if some of our folks aren't aware of that. Now, of course, if you are not looking for an options trade, like Josh mentioned, it could be a possible time where you could take a stock trade as well if you are more of a stock trader than an options trader, but you're in an options class today. So we are learning about those long options, and these are some of the components that we are going to use. So let's kind of see what a 2% move above resistance would be. We're kind of craft out our rules now before we dive into the option chain. So 2% move above resistance, let's just say the top of this resistance is 79.21. So 79.21 was that zone. 79.21 times 1.02 is how we're going to get that entry, and that is going to be at 80.79. So 80.79 or higher, and we're trading above that. Fabulous. Okay, so we have the green light to place this trade here. If we go to the trade tab here, let's take into account all the things that we discussed. So we see there's heavy activity in the call specifically, but the put options as well. So we can kind of sense that there could be a good amount of liquidity in these options here. So let's look out to July in this case. So let's look out into July because we wanted that at least 6 months of time. We're going to give ourselves a little bit more time there. Maybe even look at June because it looks like June has more liquidity in the contracts here. So let's look at June here. So I'm going to collapse this sidebar so we can kind of take a look. And we do see that there is a few hundred contracts in open interest. We have a very light volume on the day. Depending on the spread is what we'll kind of choose, depending on how tight the spreads are. And I'm looking at this 80 strike call option here. There's only about, I would say this is probably like a 7% spread. We want to kind of stay away from anything that's like 10% or greater. So let's go with the 80 strike. It has a delta of 60, so it is in the money. We talked about what that delta means before. We're going to have little to no time decay there. We talked about that theta decay as well. And then since we're at it, we're talking about the Greeks and some of those concepts. Since we haven't touched on implied volatility quite yet, this Vega is going to give us the indication of how much our option is going to move with a 1% change in implied volatility. Now, keep in mind, volatility is going to fluctuate over the life of this option. They're going to have a couple earnings announcements. Obviously, there's going to be FOMC meetings, all news that comes out, all the fun things. Right now, implied volatility is relatively low. So if we kind of took a chart of implied volatility for this stock and looked at it over the past year, it's in the 17th percentile. So it's literally in the lower fifth of what we've seen. So just kind of keep that in mind. Obviously, we're getting those options at a little bit of a discount here because of the implied volatility. But again, we're going to see those fluctuations over time. So not taking that into huge consideration when crafting this trade here. But let's use this as an example, the 90-30. So if I right click on this option, buy custom with stop, the same as what we did before here. And I'm going to open up this order, or I guess our notes from the left-hand side. We obviously already saw that move above resistance. I'm going to try for the midpoint here. You can always back it out towards the natural. We want to have control over the price on the entry just for this example trade. And then as far as our downside, we wanted to get out if price moved below 77.77. So this is obviously how much we are paying for that option. That is our max loss. Our premium that we are paying is the most we can lose. We are going to make sure that we do not lose that much, even though it is within the risk parameters of our account. We want to have a quicker exit if that is the case. So if price re-enters that pattern, we don't necessarily know what that price of the option would necessarily be if the stock went down to 77.77. Lots of sevens. So we can kind of use a couple different things to kind of sense that out. So let's collapse that again. I'm going to look at the Theoprice mark feature. We've went over this in a couple different classes. So if we go to a stock price adjustment of, let's say the stock goes down. So if it's at 81.08 right now, 81.08, it goes down to 77.77. That's about a $330 move. So I'm just going to say $330. And I'm going to look at that here and see. Oops, that kind of messed up my order. So the theoretical price of our option, if the price of the stock were to go down, and this is today, so let's just put this out to, let's just put that out a week from today. So if the price of the option, whoops, that order ticket keeps popping up there. So if the price of the stock were to make that move back down into the pattern over the next week, because we're using the next week because typically when we see a pattern breakout, and if we see a pattern failure where it moves back, it usually happens within a couple days. So it's usually kind of like that quick false move, quick move back, and failed moves to the upside can create fast moves back down to the downside and vice versa. So kind of keep that in mind, but that gives us an idea of where we could possibly place a stop, maybe right around $7 or so if we did see that move to the downside. Now I know it is kind of, since we are entering around $9 or so, it is kind of a tight stop, but again, we want to kind of keep that in mind if price re-enters the pattern there. So I'm going to build this trade out again for us. I'm going to right click, buy custom with stop here. And let's just place our stop at $7, and we're going to make that good till canceled. So good for 6 months. Now, this is going to get triggered if the asking price of the option, because that's what the standard is, if the asking price of the option reaches $7, it is going to become a market order. I discussed before in our last trade kind of the risks, the benefits with that type of trade. Now, since we are only risking $230 within this window, that gives us the chance to bump up the amount of contracts here. So if we're looking at doing 4 contracts at 930, so I'm going to take 930 times 4. That's a trade size that is roughly 37.20. So that still gives us enough kind of space there. Now, if we have a $230 kind of gap between that, multiply that by 4, that still allows us to stay within our risk parameters at 920. Let's bump that one more up to the upside, and we're just perfectly in our trade size and within our risk parameters there of not risking more than 1% of the account in a trade. So let's take a look here, and I am going to hit confirm and send on this trade. I'm going to put this at the midpoint there. Oops. Okay, it's locked in now. Confirm and send. We are going to place this in the long options account. Everything looks okay to me. We see that max loss is the premium that we are paying, but we are looking to stop that out a little bit before then. And I think it moved down my stop a little bit. Okay, moved it to 690. We'll just leave it at 690. And then we can hit send here. Okay. So we have a fill on that trade there, and I see Brent found that webcast in the chat. Thank you so much for that, Brent. And thank you so much for answering all of our questions and comments today. So this was 2 example bullish trades for you that we are going to check in for next week. I want to thank you all in the chat for just kind of your engagement, your questions, your comments throughout the session today. Thank you to the producers behind the scenes, and thank you, Brent, in the chat for always helping out. Please follow Brent and I on X. We post a ton of charts, market updates, things like that. He is Brent Moores CS. I am Rachel-CS. And I do want to say, please, if you liked this video, please give it a thumbs up. It'll help your algorithm. It'll help other traders' algorithms as well. And then please subscribe to our channel, Trader Talks Schwab Coaching, as well. Now, stay tuned. I'm actually teaching the next class here at the top of the hour at 2 p.m. Eastern Time on getting started with technical analysis, where we will go through trading systems using the Bollinger Bands and show you a couple quick tips around that. So definitely stay tuned, but thank you all for tuning in today, and I hope you have a great rest of your week.